10 different types of financial investment vehicles to save and grow wealth. Investing can be a great way to build your wealth over time, and investors have a range of investment options from safe lower return assets to riskier higher return ones. That range means you'll need to understand the pros and cons of each investment option and how they fit into your overall financial plan in order to make an informed decision. It's important to weigh these options carefully and fully understand the financial risk. Not all types of investment vehicles have the same reward, and not all have the same levels of risk in investments. So today, this episode will cover the top 10 types of financial vehicles to save and grow wealth. We'll also talk about how they differ from each other and the types of risk involved. But before we go too far, don't forget to hit that subscribe button so you don't miss the future episodes about investing and our recommendations for the best brokers to choose. What are investment vehicles? Investment vehicles are assets offered by the investment industry to help investors move money from the present to the future, with the hope of increasing the value of their money. These assets include securities such as shares, bonds, and warrants, real assets such as gold, and real estate. Many investment vehicles are entities that own other investment vehicles. For example, an equity mutual fund is an investment vehicle that owns shares. Now that you know what investment vehicles are, let's take a look at the different types of investment vehicles. 1. Savings account. A savings account pays you interest on your cash balance, and they are accessible vehicles for your cash. With fewer overhead costs, you can typically earn interest from your bank. Plus, you can typically access the money by quickly transferring it to other banks or maybe even through an ATM. A savings account is a good vehicle for those who need to access cash in the near future. A savings account works well for risk-averse investors, and especially for those who need money in the short term and want to avoid the risk that they won't get their money back. The bank that offers these accounts are insured, so you don't have to worry about losing your deposit. 2. Money market account. A money market account is an interest-bearing account at a bank or credit union, not to be confused with a money market mutual fund. Money market accounts are offered at traditional and online banks and at credit unions. They have both advantages and disadvantages compared with other types of accounts. Their advantages include higher interest rates, insurance protection, and check writing and debit card privileges. Banks and credit unions generally require customers to deposit a certain amount of money to open an account and to keep their account balance above a certain level. Many will impose monthly fees if the balance falls below the minimum. 3. Stocks. Stocks are one of the most common types of investment classes. When you buy stock, you're essentially buying a piece of ownership in a company called shares. Investors purchase shares that increase in value as the company grows. Investors can then sell these shares down the road and make a profit. Stocks can appreciate or depreciate in value, so they carry some inherent risks. When you buy shares from a company, you become a shareholder and share in the company's profits. Companies sell their stock through a stock exchange, like the Nasdaq or FTSE 100. Investors buy shares through stockbrokers. Since the growth of a company can fluctuate, the value of stocks can fluctuate too. The goal of investing is to predict which shares will grow, invest, then make a profit after the share value has increased. 4. Bonds. Bonds are a fixed income investment between an investor and a borrower. Bonds are essentially a loan that you issue to some entity, corporate or government, with the promise of repayment by a fixed date. Those who own bonds are called debt holders or creditors of the issuer. Here's how bonds work. When companies need money for projects, they issue bonds to investors. Bond agreements contain information about the terms of the loan, amount of interest payments, and maturation date by which the funds need to be repaid. Debt holders get paid regular interest payments over the life of the bond agreement. Bonds generally have low risk, but they have some risk. The risk of a bond is generally determined by the issuer's credit rating. The lower a company's credit rating, the more likely it is that the company will default before the maturation date. 5. Mutual funds. Mutual funds pool money from multiple investors to buy a wide range of assets, including stocks, bonds, and other assets. You can think of mutual funds as collective investments. A large group of people all invest their money in a pool of securities and get a piece proportional to how much they put in. Mutual funds are managed by professional money managers who determine how to distribute the fund's capital. The expense ratio of a fund determines how much money in the fund is used for operating and administrative expenses. Mutual funds are different from stocks and bonds because, unlike stocks, they do not give owners voting rights, and unlike bonds, returns track market performance instead of interest rates. Mutual funds are also subject to all the risks that specific security types are subject to. 6. ETFs. An exchange-traded fund, ETF, is a type of investment fund and exchange-traded product. They're traded on stock exchanges. ETFs are similar in many ways to mutual funds, except that ETFs are bought and sold throughout the day on stock exchanges, while mutual funds are bought and sold based on their price at day's end. An ETF holds assets such as stocks, bonds, currencies, and/or commodities such as gold bars, and generally operates with an arbitrage mechanism designed to keep it trading close to its net asset value, although deviations can occasionally occur. Most ETFs are index funds, that is, they hold the same securities in the same proportions as a certain stock market index or bond market index. The most popular ETFs in the US replicate the S&P 500 index, the total market index, the Nasdaq 100 index, the price of gold, the growth stocks in the Russell 1000 index, or the index of the largest technology companies. 7. Precious metals. Precious metals are metals that are rare and have a high economic value due to various factors, including their scarcity, use in industrial processes, and role throughout history as a store of value. The most popular precious metals with investors are gold, platinum, and silver. As an investment, precious metals are often sought after to diversify portfolios and as a store of value, particularly as a hedge against inflation and during times of financial uncertainty. For commercial buyers, precious metals may also be an essential component for products such as jewelry or electronics. The single most popular precious metal for investment purposes is gold, followed by silver. Precious metals used in industrial processes, meanwhile, include iridium, which is used in specialty alloys, and palladium, which is used in electronics and chemical applications. 8. Derivatives. Derivatives are investment vehicles that derive their value from some underlying asset or group of assets. The price of derivatives is based on price fluctuations of the underlying asset. Normally, derivatives are bought and sold to hedge positions and speculate on the movement of markets. Future contracts and option contracts are two common types of derivatives whose value derives from the speculated price movement of some underlying asset class. Although some derivatives can be used for investment risk management, the investment risk of derivatives tend to be high because the underlying assets can fluctuate widely in price. Derivatives allow for larger risk while putting little money down, which can generate huge losses if things go poorly. Derivatives are subject to market risk, interest rate risk, and liquidity risk. Liquidity risk is probably the most important kind of risk derivatives face. 9. Commodities. Commodities are physical goods that people buy and sell. Common commodities for investment include agricultural products such as wheat and barley, energy products such as oil and coal, or precious metals like gold and silver. The purposes of investing in commodities is to store money in the form of some physical good that is predicted to rise in price. This means there is a risk that the invested commodities will go down in price. The exact investment risks depend on the specific commodity, but commodities in general tend to be riskier investments. This is because the price of commodities can fluctuate widely. Some commodities, such as gold and silver, seem to be relatively stable. Crude oil, on the other hand, is a very volatile commodity. 10. Real estate. Real estate is another popular kind of investment. Property investments technically count as fixed income investments, but have some unique features that set them apart from other kinds of fixed income investments. Property tends to be resistant to inflation risk because physical properties retain their intrinsic value. Also, many countries offer excellent tax benefits for property owners. Physical property has an excellent long-term track record of growth also. Even when accounting for the mortgage crisis during the 2008 recession, property prices on average have increased every year since the 60s. There are many ways to invest in real estate as well, either through rental properties, real estate investment trusts, and mutual funds. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. If you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.